Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, a network for family offices based in Greenwich, Connecticut. Circulus will be holding its next Family Office Summit on May 15th in New York for 75 family offices and will feature legendary HBS professor Andre Perold, Jim Tannenbaum, founder of Foresight Capital and previous guest on this show, as well as Roger Ferguson, the former vice chairman of the Federal Reserve, in conversation with Rebecca Patterson, also a former guest on this show. If you are a part of a single family office, you can apply to attend at circulus.substack.com. Joan Solotar is global head of Blackstone Private Wealth and a member of the firm's management committee. Joan's career tracks the fascinating evolution of Wall Street over the past 30 years. Joan worked on three notable IPOs, DLJ in 1995, Goldman Sachs in 1999, and Blackstone in 2007, all of which we discuss. She was tapped to lead the development of Blackstone's private wealth group, which she has since grown to $250 billion. We talk about the state of the industry she covered in the 1990s, the challenge of building a two-sided marketplace, Blackstone's management committee and how they prioritize, and the wisdom of building businesses organically. Before joining Blackstone in 2007, Joan was head of equity research at Bank of America Securities, a highly ranked institutional investor all-star financial services analyst at Credit Suisse and Donaldson, Lufkin, and Jenrette. Joan is a member of the Board of Trustees of the East Harlem Tutorial Program and the East Harlem Scholars Academies. Joan received a BS in Management Information Systems from the State University of New York at Albany and an MBA in Finance from New York University. Please enjoy my conversation with Joan Solotar.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
Tell us a little bit about your background. Was there another career path in there?
Yeah, so I majored in Management Information Systems undergrad, which is coding and systems design. Most of my classmates wound their way towards consulting or something similar, but I was always interested in markets and finance. I didn't know anyone who actually worked on Wall Street, but I read the Wall Street Journal. I was analytical, I was intrigued, and I had this idea that it would be more interesting for me. I sent out resumes to all the firms that I could see listed on tombstone ads in the Wall Street Journal, because we did not have the internet way back when. And I was hired by a research analyst at First Boston in actually two sectors, savings and loans and banks. And I was applying to everything and anything, but this particular role was in equity research. And I had, during summers, actually every summer during college, worked for a marketing research firm. So it seemed in my mind to align. I didn't really know what equity research was exactly, but it had the word research, and that resonated with me. But I was hired by the bank analyst to help create a merger model that would sit on a mainframe computer, which dates me, of course. And the challenge was that I did not know how to read bank financial statements. Wasn't anything I had learned in college. So it was a tough start at the beginning. And I'd say it led to a fortuitous path. So I was working late every night. And one night, the insurance analyst, David Seifer, came back from a dinner. It was about 10 o'clock. No one else was in the office other than me. And he looked at me and said, "I need you on my team," purely because I was there late at night. But ultimately, I did actually join his team a few months later. And he was hired by DLJ to help build out the research and investment banking franchise in insurance. He was the number one ranked research analyst for a very long time, and also to help demutualize the Equitable, which owned DLJ. And so I joined him there and ultimately was given my own coverage of the brokerage and asset management industry.
And how did you find the industry at that point?
Back then, You did not have much in the way of hedge funds, so it was very much dominated by long-only firms, large long-only firms for the most part. You had just a few companies that were public in the brokerage and asset management industry. And actually during the 90s, a big change was the re-equitization of America, if you will. Firms were deleveraging, markets were friendly, you had a lot of companies go public, including DLJ, which I worked on, Goldman Sachs, and others. Today, you have the reverse, shrinking number of companies public, so it's been quite a cycle. But it was just such a great place to start. It was analytical, it was client-facing, I loved writing, loved market. I felt like I really learned how to assess strategies, what worked, what didn't, quality of management teams, which means everything, running an organization. And I learned from all the other more senior and experienced analysts around me. It was great.
And what was research like back then? How did you spend a lot of time with the executives? Did you spend a lot of time visiting? Did you spend a lot of time on the books?
I'll tell you how it evolved for me. It was very eye-opening. So at the beginnings, my job was to create models. And so I was all in the numbers and reading the research reports. And I should say the financial statements, 10Qs, 10Ks, annual reports. But I would read what the analysts wrote. I was the junior person on the team. I kept thinking, I don't understand. I'm going through the numbers, I'm reading the 10Ks, and where are they getting this from? And it wasn't until I started meeting with management teams and clients and doing field research that I got the 360 worldview. So in insurance, meeting with insurance brokers and understanding pricing changes allowed you to anticipate cycles, for example. And when I was covering my own sector, getting out there and really talking to whether it was traders, bankers, management teams, getting that full 360 view really gave you well beyond the numbers what was actually happening and trends. I would say it evolved. If you move forward today, it's so different. I'm no longer doing that, of course, but information moves much more quickly. I even think back to initially when companies reported earnings, we would get the releases by fax. And I remember going down to Pine Street to pick up the AIG quarterly earnings release so that I could get it before it was faxed, and then I would take the train back to the office. Someone told me when First Call emerged, which had information about companies, it was really the first time that you could aggregate it. Research analysts won't be needed, and this was so many decades ago. And they're still needed, but I think it's a much different role today. I think there's a little bit less access generally to management. There's much more sensitivity to the kind of information that you would get from clients and the like appropriately to make sure that no one has, putting this in air quotes, inside information or actual inside information. So public markets are a very even playing field as opposed to private markets where you're signing a non-disclosure agreement, and so you in fact are getting access to much more information.
So I'm sure most of the folks listening will know about DLJ, but maybe talk a little bit about the firm, why they were special, and what led up to their essentially groundbreaking IPO.
Yeah. So DLJ was founded as a research firm. Dick Jenrette famously wrote a paper called Common Stocks and Common Sense, real fundamental research. And all of the investment banking franchises were linked to research franchises. We worked hand in glove, which actually was terrific. So you really got to think about strategy, financings, M&A, all of the parts of companies, and who ultimately, many of them became clients of the firm. DLJ was early in what was then merchant banking, now private equity. Tony James, who ultimately was president here, ran that business at DLJ. It was, during its time, actually the largest merchant banking firm. it tended to focus on middle market in all areas of business and just had a fantastic culture. Collaborative, entrepreneurial, scrappy. We were capital constrained, which I think actually benefited us in a lot of ways because we didn't experience the kind of trading losses and swings that had occurred at other firms. And ultimately, the firm went public again. It actually was the first firm originally to go public on the exchange in 1970, but was bought by Equitable and then spun out again in 1995, and then was bought by Credit Suisse in 2000.
And what was the reason for the offering in 95? Because Goldman had a number of issues in 99, which we can talk about because you worked on that IPO as well. They were capital constrained. They were trying to attract talent from hedge funds.
So it was very similar. We were capital constrained at a time when we were trying to globalize the business in all areas. And the cost of equity was not terribly high. Multiples, equity markets were strong. Multiples were high, especially for growth businesses. And we were able, I don't remember the precise multiple, but it was in the 20s in terms of a multiple of earnings. So we were able to raise capital pretty inexpensively at that time. So I think it was just fortuitous timing.
And so tell us a little bit, how did you end up working on the Goldman IPO and how was that different? It was a very different period, 99.
Yeah, so I was a top-ranked analyst covering the brokerage and asset management companies. So I worked on virtually every IPO in that sector. So in those days, research analysts were one of the primary reasons that a firm would choose an investment bank to either lead or co-manage their IPO. For Goldman Sachs, DLJ was the independent pricing agent. Goldman led its own IPO. And it was a fascinating time. You had the tech boom and Goldman was dominant. Goldman Sachs and Morgan Stanley had massive market share in the technology space, and that was dominating almost everything that was happening. But it was such an interesting company in that it wasn't just banking. Goldman was unique in being able to bring the total firm to a client. They were so well coordinated, whether it was debt financing, equity financing, M&A, working with the management teams on the private client side. It really was full circle, incredibly well managed firm, and then of course had trading prowess that was the envy of many others. So it was really fun to work on, and then I covered the company for a while, but I haven't been a research analyst since, 2002.
Looking back now, there was a big debate then about culture and what the IPO would do to that. What do you think about that now?
I feel the same today as I did then, which is it's not about being public versus being private. It's about growth. And how do you manage a firm that is growing significantly and that is becoming more global? And I think about that a lot as it relates to Blackstone. So when we went public, Steve Schwarzman said upfront to all shareholders, you should know we are going to be a different kind of public company. What matters most is the investment returns and what we're delivering to our investing clients. That should benefit you as shareholders, but we are not going to flip into an asset gatherer, marketing machine, forgetting about the investment side. One fuels the other. You drive good returns, people want to give you more of their capital. And I'm relating it to Blackstone's, my current experience, and we went through the same thing. We were a much smaller firm then. What's been interesting here is the deliberate focus on knitting the firm ever closer together, even as we became more global. And I think across this firm, folks would tell you that, versus 5 or 10 years ago, it's much more fluid in terms of information, deal flow. Everything just moves in a really deliberate way. And whether you're sitting in Mumbai or Tokyo or New York or London, it really doesn't matter. You have access to the same information. I know folks in all of those offices quite well. We communicate very frequently, and you have to be deliberate about that. So when I look across, whether it's the asset management industry or the brokerage industry, and firms don't have that, I think it's, again, less about being public versus private and more about how they've siloed their regions or their individual businesses.
How did the industry change after the tech bubble?
Changed in a lot of ways. So during that period, it was frenzied. There were so many companies coming public. All these new metrics were emerging, right? That was the other issue, if you will, when you start counting eyeballs on a website as a metric for whether a company will be successful or not, and you're not focusing on cash flow and earnings, that could be ultimately problematic. And the cost of raising equity capital was virtually zero. And these companies were unprofitable. They were going to be unprofitable for the foreseeable future, and the market was willing to give them a ton of money. That said, the internet was real, and it shaped so much of what we take for granted today, e-commerce and the like. But it took a long time to get there. You had winners and losers. When the bubble burst, firms had hired a ton of people and had to shrink, cut expenses. There were trading losses. I think it was searing. You had a lot of money in growth equity, and I'm talking about publicly traded growth equity firms and funds. Those lost a ton of money. It was a time, I think it was a wake-up call for a lot of people, but I actually think it transformed the private wealth business as much as it did anything else. You don't hear the term stockbroker any longer, but in those days, financial advisors were actually picking stocks, and ultimately, many of those did not perform well. Clients lost a ton of money. Some of them went bankrupt. And there was a movement to shift from stock picking to fund picking. And I would say today that's moved even further with an emphasis on asset allocation. So it's been quite an evolution. I think the outcome is better for investors. I think it's better for clients.
How did you actually get the job at Blackstone?
Tony James was president of the firm. Blackstone had filed to go public in March of 2007. I was running equity research at the time at Bank of America. Tony left me a voicemail asking if I knew anyone who could come over to Blackstone and help build out shareholder relations. I called him back, left him a voicemail saying, I know lots of people. Let me know whether you want senior, junior skill set. Ultimately, he described what I felt was my skill set, and I asked if he was interested in talking to me about the role, started meeting with him, and then we shaped a broader role beyond shareholder relations, but that was most essential when I first came over. There really weren't folks here who had public company experience, and it was exciting to be here, and I thought, I have no idea how this will work out, but this is going to be an incredible experience for me. I so enjoyed the conversations with every single person that I met. From the outside, it felt like a very intimidating firm, but from the inside, it was collaborative and welcoming in a way that was surprising to me. Maybe it shouldn't have been, but it was. And I'm still learning a ton. I just learned a ton, and it was fascinating. After I arrived, we went public. I was attending not just the Monday investment committees, but at that time, review committees, because I needed to steep myself in what everyone was doing, process, and those committees occurred before the Mondays at Blackstone committees, which I could talk about after. But a week in, Tony James asked, what's most surprising? And I said, what's most surprising is how everyone feels very comfortable attacking the deal, whether they're junior or senior, and how they're expected to. I had never experienced that in an investment bank. If you attacked someone else's deal, you were like enemy number one. It was a tough conversation. And here, the only goal was to get to the right investment outcome. and everyone wanted to know all the things that could go wrong. And if you were, trying to just sell the deal, et cetera, that didn't work. But it was also how people were motivated. They weren't paid on their deals, they were paid on the outcome of the fund, so how clients did. Just a very different mindset. And I think it speaks to how the firm still thinks about client outcomes, and it's not about getting the most number of deals in the fund, it's about the fund actually performing well. And then you will benefit because the fund will yield carry and you'll get a piece of the fund's carry. So I think that fosters a ton of collaboration that still exists, probably even more than it did then, but it's been amazing. So that is how I landed here.
At the time, the big debate was, how are we going to value carried interest? Was that a big discussion?
Yes, it has evolved. I'd say today there are more companies public in the industry. We've now been public almost 18 years, and so we are cycle tested, if you will. At that time, the view was, actually two things have changed. The view was we could see what your management fees are in your current funds, but we have no idea if you're going to earn carry. Even though we had earned carry on pretty much every fund we had ever managed, which would suggest that there is a predictability to it, but it was a new sector. And even on the management fees, because you raise the money, you invest the money, you give back the money, and then you have to raise the next fund, ultimately investors would question whether you could raise that next fund. We were managing $88 billion at the time that we went public, and the most frequently asked question that I received was, how can you possibly grow from here? That was really it. And today, of course, we're managing over $1 trillion. So we proved that we can do it. But to your initial question, carry was viewed in very much the same way as trading revenues at an investment bank, only it's really a one-sided option. Trading revenues can be losses. Carry, you either earn it or you don't, but you don't have losses attributed to it. But I think since we've been public 18 years and they've been able to see that we do earn carry on those funds, the firms are valued much more on a total earnings basis now rather than sum of the parts, which is how it was initially valued.
So we had another change in the industry in 2008. How did the industry shift after the '08 crisis?
Yeah, that was something. I think back, and it's hard to imagine living through a period where banks wouldn't lend to other banks. I don't think that had ever happened in history. You had firms that were long-standing institutions going bankrupt and needing the government to keep them alive. So it was a pretty terrible time. And I would say here, from a stock performance perspective, we had gone public at 31, and at the low, we were $3.55. I believe we had more cash on our balance sheet than that. But
were you a buyer there, Joan?
I bought actually at $6.88 before it went to $3.55. But I felt very confident and comfortable because we were not a levered institution. We had no debt. We had credit lines, and that really also shaped how we thought about financing the firm, because prior to that, there wouldn't have been a period where a bank would say, we're not going to renew your credit line, and really caused us to do our first bond offering, because we realized we don't want net debt, but we need some access in addition to these credit lines that we may or may never draw down upon. During that period also, I don't know if you remember, firms started just drawing down on their credit lines because they were worried that they would disappear. I think when you go through a cycle like that, it absolutely creates the ability to see something that didn't exist before and protect the firm from harm in case something like that ever happens. It was interesting, Steve Schwarzman would regularly leave voicemails for the entire firm, essentially saying, we are okay. If you recall, the difference between private equity and our structures and the mutual fund companies. So the mutual fund companies at that time, they were seeing their assets go down by 50%. But our capital's locked up in the drawdown structures. Fees are based on committed capital, not the marks. So if your assets marked all the way down, it doesn't affect your management fees. So we were steady Eddie. We had no reason to reduce our workforce. And in fact, for us, it was about making sure the portfolio companies were in good shape. It was about extending maturities. Hilton's probably the greatest example of that, one of the most profitable deals ever. But during the financial crisis, we were carrying it down at 35 cents on the dollar. John Gray was running real estate at that time. It was not easy, but they were able to extend the debt, lock in capital, which was super important. Were able to get through the other side, and ultimately investors made 3 times their money on the transaction because you have the staying power. Again, it's the advantage of being a private owner versus a public owner. But it was challenging, and even though our firm fared well and everyone here was quite comfortable, seeing clients, peers, former colleagues lose their jobs, people were losing quite a lot of wealth and across the country, and it was pretty distressing period.
Blackstone started in advisory, then raised a private equity fund, then moved into hedge funds and credit. They've successfully started a number of new business lines over the years. Could you tell us the thinking behind the private wealth effort?
Yeah. So this is a strategy that I worked on with Tony James in the way back. And it was a strategy not exclusive for private wealth. We were rethinking all of distribution. At that time, or at the time that we went public, about 2/3 of the firm's assets were from U.S. pension funds. And we were thinking about how to broaden that. So there was also expansion globally. It was the first time that we were putting folks in our institutional fundraising arm in Europe and then Asia, ultimately. And as it related to private wealth, we evaluated a lot of different paths. Do we create a Blackstone private bank? Do we buy a private bank? We had lots of people coming to us telling us that they could build out a very high quality private bank here. But ultimately, we landed on the idea that we want to be the best partner to financial advisors, that you could get the most leverage that way, and that what we were great at was investing. And that's what we ultimately did. The idea initially was to start with the big wirehouses and firms like Merrill Lynch, Morgan Stanley, UBS in the US. And then I was asked in 2015 to take over the management of the business and really build it out into something global, leading in scale. So since then, we have evolved in terms of how we think about product, how we think about regions, how we think about serving clients. And we've been able to scale the business now to greater than 260 billion. That's a very meaningful part of Blackstone's AUM. And we have big ambitions of growing that to $1 trillion. I can't tell you exactly the time frame. I was wrong on 250. So 2018, I guess the fall of 2018, I said I thought we would hit 250 by 2028. We hit that early, and I can see a path to $1 trillion, but it's always difficult to know exactly when you get there.
So building a two-sided marketplace is difficult. What were the very first steps to create that business? How did you get buy-in from the institutions?
Yeah, it's interesting. First, you have to get buy-in from your own firm. And I spent a fair amount of time with our board, giving them comfort that we would not dilute the brand. There was a concern because we were the reference institution on the institutional business, and now we were going retail, private wealth. How do you not dilute the brand? And you don't dilute the brand by bringing the same level of excellence to both product and service that you do on the institutional side. So the key was hiring really talented people, training them exceptionally well, and listening to what the firms, the private wealth firms, actually needed on their side. And it was clear that they needed not just product, but they needed service, they needed education. These are not like buying stocks and bonds. And I have to say, they've been amazing partners. They inform a lot of what we do. We talk to them as we think through new products and ideas. We're always evolving and moving forward. So it's been quite a journey, but that was the idea. So we had to get buy-in from inside the firm. Externally, to your question, there was a cynicism around institutional firms coming to private wealth. Like, why? Why do you want to do it? And I think other firms that had approached the market in the past didn't leave clients with a great experience, and they were just trying to sell funds that perhaps they couldn't sell institutionally. So the other piece of it was we were only going to bring institutional quality funds run by the same teams, so you don't get the B team, and again, match that with truly excellent differentiated service. And I think that's what we've been able to do. We've learned a lot over these many years, and we've evolved. We've added to our roster not just product, but how we serve these firms. And then we've been able to take that to other distribution channels, whether it's the RIA channel or the mid-sized broker-dealers, and then internationally, across Europe, across Asia, newer countries for us like Japan, Canada. And it's always easier to look back when you've established something big and say, oh yeah, sure, that makes sense. But at the time, for example, going into a country like Japan, I think other firms probably looked at the market and said, the Japanese private wealth market doesn't own alternatives. Like, why would you build out a business? The same in Canada. But that's why you build out a business, because they don't, but they could benefit from it. And if you could get buy-in from the big firms and ultimately from the financial advisors, those are very untapped big markets. And that's been our approach. It's been our approach here and really everywhere around the world.
So you just touched on it, but I'm always interested in how large firms decide what goes on the platform. Do you want to offer everything? Do you think of yourself as more reactive or prescriptive?
Each firm is a little bit different. And on the private market side, it's unlikely that firms will want to onboard 50 different open-ended private equity funds, because none of those will scale or very few would. So they tend to curate. But some firms will want 2 or 3, and others will want 20. So it does vary. It's not one size fits all. From us, of course, there's what we see. They do a ton of due diligence. So they want to understand who's managing the fund, what's your track record, what is the structure, does it actually work? Is this something that fits into their top-down view? I think that's the other piece. If they're particularly negative on an asset class, it's unlikely, even if you think it's the greatest fund in the world, that it's going to be onboarded. And so we've had, I think for us, a very good experience, because aside from the drawdown funds, which we still offer, so when we brought funds in other sectors, whether it was private credit, private equity, private infrastructure, they were more apt to believe that we would do a good job, which we have, for their clients. And so we recently launched our infrastructure fund, and we had a very large first close, which is publicly disclosed. And when we looked back at the advisors who allocated to it, over 90% had their customers in one of our other funds. But I thought even more interesting than that, slightly more than half of them had customers in all 4 of our open-ended funds. So I think that speaks to the very favorable flywheel effect. It's in finance, as it's not just about investment returns, which are super important, it's also about trust. You're handing over your money, you're handing over your client's money.
Outside of AUM, what metrics have you used to measure the success of the private wealth effort, and how do you know when it's not working?
That's a really good question. So of course, we're always happy when customers are buying, so that's a great metric. But we actually do quite a lot of surveying of financial advisors to get their feedback. And I would say generally, financial advisors are not a shy lot, so they let you know if they are displeased with something. Overwhelmingly, we get very favorable feedback actually about our service and how we treat them. And again, this isn't about me, so it will sound like I'm being braggadocious here, but they do tell us that we have the top people in the field, that we have the top people, the investment services team, on the desk, education, all of that, just a cut above. So that makes me proud. But I would say that's really, we get that feedback. We also look at when we are meeting with advisors, we capture that information and then we evaluate, are they doing more business with us? Does this resonate? And if not, we try to tweak things and make changes. We're still learning, we're still evolving, and we're still getting that kind of feedback. We had, I guess it was 2 weeks ago now, 100 advisors in our offices. These were top advisors from one of the big firms and also across the RIA community. These are advisors who've done a lot of business with us. And we're treating them as we should, like they're special. They had time with senior management, senior investors. We're giving them special, faster response time in terms of investor services, because as I mentioned, these aren't like buying stocks and bonds, so you need a little more hand-holding. And I think that matters to folks. I think it's differentiated, and it's about having the resources to actually build a top business. So what we hear is just that they know we're here to stay. Like, we've been at this for a long time. We bring a lot to them. And when we talk about partnership, we mean it, right? Like, we're trying to help financial advisors build their business. Many of them are using private investments as a way to attract new assets or new clients. So if we could work, it's win. When they're growing, we're growing. When we're delivering good results, we're helping build their business.
I'd love to talk a little bit about the management committee. Maybe you can bring us into the room as much as you can. I think it's fascinating how many amazing strategists are in that room, but how do you decide what are the priorities of the firm? Because you have all of these somewhat disparate revenue lines.
Yes, so it's smiling in this room because when I delivered my strategic plan a couple of years ago, Steve Schwarzman said to me, "You've mentioned the word priority a few times, but I'd rather you just do it all." So, I was like, okay, there we go. You prioritize by going after the biggest opportunities. And right now, there are massive opportunities that we see, whether it's regionally or asset classes, funds that are still nascent, sectors that are still nascent. And that's what you're going to put your muscle against, because that's where you're going to drive the biggest results for the firm. So that's how we think about it. So when we're evaluating an idea, particularly if it's a new strategy or new distribution, it's, do we have the right team to prosecute that idea? Is it something that can, on an enduring basis, bring a positive result to customers? So we're not interested in the idea of the moment, something that cyclically looks good, but in a couple of years won't look good. You want to build things that are enduring and growing, that have downside protection, where you have excellent people who can manage that business or that fund. So those are a lot of the parameters that we're looking at. And then if it's still a great idea and it's a huge opportunity and you don't have the right people, can you hire a 10 out of 10 to build that business? So those are a lot of the discussions. And then of course we're talking about the results of the firm. We're going over the financials, the outlooks, the performance in every one of the funds.
What's an average meeting like?
I would say there's always topics to be discussed because there's so much happening around the firm. We often start with Michael Che, our CFO, reviewing the financials, both the quarter, the year, the outlook, what could move either way. That's interesting to all of us. And then typically we will have a number of topics. It could be an update. So I might be giving an update on my business and sentiment in all the different regions, what's working, what might not be working, what we're thinking about in terms of timing on new products and funds. And so it's a lot of updates from each of us around what's happening in our business. And then Steve will often share his insights from what he's seeing around the world, meeting with business leaders, investment leaders, government leaders. And he's really, I think, a unique individual in his ability to have conversations and then weave them together to paint a very clear picture. So I think we all benefit from that. Typically it starts, it's every Wednesday, starts at 8:30, and we're scheduled till 11. Sometimes it ends early, sometimes we go the full time depending on what's on the agenda. And then sometimes we pull people in from other businesses if there's a particular topic of interest that everyone should hear about.
I'm interested in how the information and knowledge flows through this firm, because I've always thought one of the competitive advantages is the feedback from the underlying companies, how that influences your work, what the LPs think, all of the folks who you're talking to, folks outside the industry. But it's the sharing of information internally, and that there's a structure to ensure that information flows. That becomes your competitive advantage.
It is a massive advantage, and it flows in numerous ways. I think the open-ended perpetual funds have actually increased the information flow because, for example, in our private equity fund, you can invest from anywhere, right? It might be growth equity, life sciences, our large control deals. It could be a structured transaction in our tactical ops. And the fund itself and the team is indifferent as to where it comes from. But the teams now have a much wider aperture and lens to look through, and the information flows. So let's say someone in the private equity group is looking at a large control deal. And let's say they think it's too expensive, but they think there could be something interesting in terms of a structured transaction. That would flow to the tactical opportunities business.
Could you tell us what Tactical Opportunities is?
Oh, yeah.
David Blitzer, right?
Yes, yeah. Today it's actually run by Chris James, but David Blitzer was the founding leader. It was started coming out of the global financial crisis when there were all these transactions that didn't fit into private equity fund, but were super interesting, where you could still generate a net double-digit return and take less risk. So typically it might be a structured debt transaction with some equity kicker upside. It's probably the easiest way to think about it. So you're not doing a control deal. It also could be a minority transaction. You could be buying portfolios of assets. There's very many different ways to invest. It's the most flexible capital at the firm, I would say. And today it's actually pretty active. So yeah, that's an interesting area. So deals tend to flow around.
So here's a question that very few firms can answer. All of the wealth managers and asset managers I talk to struggle with how big is too big and the bottlenecks that occur along the way, especially now there's a lot of mergers in the RIA space, for example. Aside from talent, which we have touched on, how do you think about structuring the firm and its initiatives so that they ultimately can scale?
Yeah, so I'd say one thing that's super important, and I'm thinking about the open-ended funds, the perpetual funds, because those are changing the landscape in terms of adoption of alternatives in private wealth. You have to treat them like a business and not like a fund. And what that means is it's not just about the investments going into the fund, but who's managing the liquidity. You need a CEO of the fund. Who is going out and speaking to it? How are you drawing investments? Who's doing the portfolio management? And linking arms with us. So whether it's in real estate or private equity or infrastructure or credit, like we are linked arms. Our team and that investment team and all of the resources that they're putting around it, we're speaking every single day. So you have to run it like a business and not just an afterthought. I think that's super important. On scale, if you were talking about one big fund, nothing grows to infinity, then you would say, oh, wow, that's like a big fund. And certainly if it were on the public side where trying to execute a big trade actually moves a stock or a bond, that's very challenging. In our businesses, when we have great scale, which we do across the board, what it basically means is we have less competition. So if you went asset class by asset class, you would find we have very few large competitors in every single space. Some are more competitive than others, but there is not a large number in any of the sectors that we're in. And that means you can also do small, mid-sized deals, but when it comes to the larger transactions, very few people are going to be able to do those. And so it's been a massive competitive advantage for us. And scale really matters. And just to bring it to life, if you think about I'll just use infrastructure as an example. A lot of what's interesting in investing in infrastructure is not just the initial deal, which can set up at a good multiple if you're disciplined, but it's the follow-on investments where typically are coming in at a much lower multiple, the add-on capital, but where you really need scale. So I think about something like data centers. A lot of folks are talking about their data centers, but to really build for the biggest users, the hyperscalers, those are multi-billion-dollar data centers. So if you're running a data center fund, let's say it's even $1 billion or whatever, hard to imagine that you're going to get hired by those companies because it's so critical. You have to be able to speak to real scale in building those out. And that's just one small example, but you can see whether it's lending to bigger companies, safer companies, and having scale on the private credit side, private equity, the ability to do large transactions like a Jersey Mike's and others. Again, there was no one else. That was just us and the seller. So you can do more deals that aren't auctions, that therefore don't get bid up to some higher price, where the management team really sees the benefit of working with you and wants to roll equity into the deal, stay on, et cetera. There's so many examples of that. But again, you can only do that if you have real scale.
What do you think you can do at Blackstone that others cannot, and what things will you not do?
That's an interesting question. What can we do that others cannot? So I already said, I think our scale is differentiating. We can certainly make very high quality, large investments. I think one of the benefits at Blackstone is the culture that Steve created around relentless innovation. Nothing's patentable. Everyone can copy exactly what you're doing. And if you mentioned early on, firms started as advisory, went to private equity, went to real estate. And so I think one of the things we do is look at what doesn't exist and create it, like tactical opportunities. Of course, you have to explain what it is because it's a made-up name, right? And it's a business that didn't exist. The same in private wealth. I think it's easier for folks to today look at and say, oh yeah, that's a big market, will come in. So I think something special happens here around creating new businesses out of whole cloth and actually growing them into leading global scaled businesses. That's very unusual. But we work fast. That's what I hear when folks join. I always ask them what's surprising, and the two things they remark are that people are genuinely nice, that it wasn't just the interview process, so that always makes me happy. And second, that we move at a much faster pace than wherever the firm they were coming from. When you sign on, you gotta hold on tight and go. So I do think that's a bit unique. I think we can move faster. I think we have big ambitions. And I think we can build leading global scaled businesses rather than having to buy them.
So looking back, you spent a lot of time researching the asset management space and thinking about asset management over the years. What are things that you wouldn't do, or things that you think asset management firms maybe should avoid?
Yeah. So the things that we don't do are the things that have a lot of downside risk, or they're nice to have, but they're not really going to add scale to our businesses. And I'll give you a couple of examples. So on the first, in terms of volatility, we had spent time years ago, some firms were selling their commodities businesses. Commodities are a big space, you can earn a lot of money, and we spent a ton of time evaluating it and actually really doing a deep dive on whether we wanted to acquire teams or business, et cetera. But as much as you can earn a lot on a sunny day, you can lose that much on a rainy day. And thinking around downside protection, downside risk, those are businesses that we just wouldn't do. They wouldn't fit here. So that, I would say, is super important. Another, I mentioned scale. We had also evaluated timber at one point, which is interesting. And again, it's a great investment for a lot of folks. You could build a really nice business about it. But in the scheme of things, even if you look at the size of it globally, and you thought about what could our share be, it's just not going to be big enough scale for Blackstone. It makes sense for many other people. It's probably not going to do much. I'd say those two things wouldn't happen here.
Maybe a specific question, actually, which is highly relevant, is what are some of the issues for the asset manager offering semi-liquid funds to a larger client base, the alts going mainstream issue?
Yeah. I think when you do it, you have to go in eyes wide open that perpetual means forever. This isn't like launching a drawdown fund where you're out there marketing it for a year and then you go away and you're investing the fund, and where portfolio management probably doesn't mean quite as much as in a perpetual offering. I think the liquidity sleeve is equally important, and making sure you've really thought through how you're going to provide liquidity when many of the assets are less liquid. But these are really building blocks and important tools for private wealth portfolios when you get them right. And why is that? It's because when you look over a long period of time, whether it's private equity, private real estate, private infrastructure, private credit, the returns or the yields have been higher than their public counterparts with less volatility. And why less volatility? It's not because of marking. It's really because they are being offered at net asset value. But the stock market, and it's just one example, but it's true on the credit side too, they're very rarely trading right at net asset value. So during the euphoric periods, they trade at a premium, and during the down periods, they're trading at a discount. We have a private credit fund and a public private credit fund, and they often own very similar things, but the private fund will always be offered at net asset value, and the public fund at times trades at a premium like it's trading today, and potentially it could trade at a discount. I just use that one example. And so when you look over an extended period of time, I think the benefits are really clear. You have more offerings, not just Blackstone, other institutional quality firms now coming to market, so there's more there for investors to choose from. Advisors are getting better educated, and they're easier to buy than a drawdown fund. So if you break down the friction points and you provide more education and you have scale in these funds and more offerings, all of that leads to adoption. That said, it is still so early. It's hard to find a firm out there that would tell you the allocation to private investments is greater than 5%. Most of them want the allocations to at least double from where they are, and in order to do that, they need scaled funds.
It was interesting to do a quick back-of-the-envelope analysis of AUM versus employees, and Blackstone had one of the most interesting ratios. They have a very high AUM per employee compared to Goldman, Apollo, BlackRock, et cetera. Do you think of Blackstone as an efficient firm?
I do. If you were to, in one sentence, say, to capture your question, it would be, we are a capital light model, and that would tie into needing massive numbers of employees as well. I think we are very efficiently run.
Is there ways that you structure the firm to ensure that happens?
I think there's an expense discipline. So we all go through our budget process around hiring and spending. So we're quite planful around that. And then the capital light model, that's just the way the firm has been run from day one. Some of our peers have gone the other way and have decided to go into a more capital intensive type of business. The returns on equity are better if you don't need to utilize a lot of capital. It's the same, I think, about some of our investments. One of the themes we like are franchise businesses. And when we bought Hilton, I was really transformed from owning the properties to moving to a capital light franchise business. You can grow faster when you don't have to keep raising or adding more capital. And it's the same with our own business.
Joan Solotar, thank you for joining us and sharing your insights.
Thank you for having me on the show. I'm excited to hear.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.